Have you ever felt like you're watching two different movies at the same time? In one, the stock market is throwing a massive party, hitting record highs. In the other, people are losing their jobs, feeling anxious, and preparing for tough times. Well, that's not a movie. That's the American economy in early 2026. We're living through one of the strangest economic moments in recent history. The headlines are screaming about a booming stock market, with the Dow Jones smashing through 50,000 for the first time ever. Tech stocks, especially everything related to AI, are soaring. Bitcoin is bouncing back. On the surface, it looks like the good times are here to stay. But if you look just a little bit closer, a completely different story emerges. A story of widespread job losses, plunging consumer confidence, and a desperate search for safety. This isn't just another market cycle. We're at a critical crossroads, a turning point that could define the next several years for all of us. So let's peel back the layers and uncover what's really happening behind the curtain. This is the hidden story of America's economy, and it might be the biggest surprise of 2026. First, let's talk about that stock market rally. In early February 2026, U.S. markets did stage an impressive rebound. After a rough patch, prices shot back up. Like I said, the Dow crossed that historic 50,000 mark, driven by big tech and the unstoppable AI narrative. It felt like a huge sigh of relief for investors. But here's the catch. This rally is incredibly fragile. It's like walking on a frozen lake that looks solid but is cracking underneath your feet. Just days before this rally, sentiment indicators like the widely watched fear and greed index were flashing signs of extreme panic. I mean, we're talking about levels of fear we usually only see during a full-blown market crash, not at the beginning of a healthy uptrend. So what does this tell us? It tells us that investors are deeply conflicted. Their trading accounts are going up, which they love, but their gut feeling is one of anxiety and uncertainty. This isn't a rally built on strong, fundamental belief in the economy. It feels more like a short-term technical bounce, driven by algorithms and traders trying to catch a wave. The optimism you see in the price charts isn't matched by the mood on the ground. Now, let's turn to the second, much darker part of this story, the job market. While Wall Street celebrates, Main Street is dealing with a wave of layoffs. And I'm not talking about a small trend. The numbers for January 2026 were shocking. We saw the highest number of job cuts in a single month since the Great Recession, with over 108,000 positions eliminated. Think about that. We haven't seen numbers like this in over a decade. And these aren't just isolated incidents in one struggling industry. This is happening everywhere. UPS announced it's cutting tens of thousands of jobs. Amazon is laying off a significant number of corporate employees as it restructures and doubles down on automation. From manufacturing plants to logistics warehouses, companies are trimming their staff at a rapid pace. But the problem is even bigger than just layoffs. The other side of the equation is hiring, and that has slowed to a crawl. Companies are creating far fewer new job openings than they have in years. This creates a vicious cycle. When people see their friends and neighbors getting laid off, they lose confidence and cut back on their spending. When businesses see spending drop, they get nervous and become even more hesitant to hire new people. This feedback loop is a classic recipe for a weakening economy, and it's happening right now, even as the stock market is partying. This brings me to a crucial red flag, something that I believe is even more important than stock prices: consumer confidence. The confidence of the American consumer has absolutely collapsed. Recent data shows it has plunged to its lowest point since 2014. It is even lower than the darkest days of the pandemic lockdowns. That is a massive, flashing warning sign. Why is this so important? Because consumer spending is the engine of the U.S. economy. It accounts for about 70% of all economic activity. When people feel confident about the future, they spend money on cars, homes, vacations, and gadgets. When they lose that confidence, they stop spending. They save, they pay down debt, and they worry. And when 70% of the economy pulls back, a real economic contraction often follows. This historic drop in confidence, combined with the surge in layoffs, tells a story that most of the mainstream headlines are completely ignoring. There's a deep and growing fear in the American workforce. It's a powerful force that the stock market can't ignore forever. So if people are so scared, where are they putting their money? Well, while stocks and the real economy are telling two different stories, there's a third character in this drama that's telling a very different story altogether: precious metals. As the stock market wavers and jobs disappear, gold and silver are surging. Gold futures just broke back above the $5,000 per ounce level. This is a huge psychological barrier that very few analysts expected to see crossed this early in the year. Silver, which is sensitive to both industrial demand and investor fear, is also rallying hard. Now, why does this matter so much? Because gold and silver are the ultimate safe havens. When investors lose faith in the system, when they fear a recession or currency troubles, they flock to precious metals as a store of value. This isn't just about prices going up, it's a signal of a fundamental shift in investor psychology. It's a move away from pure risk-taking and toward wealth preservation. Historically, powerful surges in gold like the one we're seeing now have often preceded major economic events, recessions, currency devaluations, or big geopolitical shifts. So when you see gold and silver rallying at the same time that job indicators are flashing red, you're witnessing two powerful opposing forces at work. Market optimism clashing head-on with real-world fear. And a divergence like that rarely, if ever, ends quietly. To make this whole situation even more confusing, we've had another problem: delayed information. Key economic data, like the official January jobs report, was delayed. For investors, policymakers, and anyone trying to make sense of the economy, this is maddening. It is like trying to drive a car down a highway at night with your headlights flickering on and off. The lack of clear, up-to-date data means the market is flying partially blind. This forces traders to be reactive, not proactive. They're jumping on short-term price movements and rumors instead of making decisions based on solid fundamentals. This is one reason we can see these sharp, fast rallies that feel disconnected from reality. They can be built on incomplete information and can unravel just as quickly when the full and often disappointing truth is finally revealed. So let's step back and put all the pieces together. What is the real battle that's defining 2026? On one side, you have the stock market. You have record highs in major indexes, an AI-fueled tech boom, and stabilizing crypto assets. It's a picture of financial optimism. On the other side, you have the real economy. You have layoffs surging to recession-like levels, consumer confidence collapsing, and cautious employers who aren't hiring. It's a picture of deep economic stress. And in the middle, you have the safe haven assets, gold and silver, which are signaling a growing demand for security and a flight from risk. This split between Wall Street's optimism and Main Street's fear is not just a curious observation, it's a historically significant event. It suggests that financial markets are pricing in a rosy future that the real economy simply cannot support right now. Whenever a gap like this opens up between market sentiment and economic reality, a correction or a more profound shift is often just around the corner. Now, here's what most analysts won't tell you. They tend to focus on just one side of the story, either the soaring market or the struggling economy. But the truth is, these two things can coexist for a while. A stock market rally can absolutely happen at the same time people are struggling. And we are living through that period right now. But this uneasy equilibrium can't last forever. Eventually, one force has to win out. And history shows us, time and time again, that it's the real economy that ultimately dictates the long-term health of the market. If job losses continue to mount and consumer confidence stays in the basement, even the most exciting AI stocks will eventually lose their momentum. The current rally might just be the last gasp of optimism, the calm before a more significant storm. This isn't about spreading panic. It's about acknowledging the uneasy reality we're in. So, as we look ahead, we see the United States standing at a major financial crossroads. One path is lit by the glow of stock market gains and technological promise. The other path is shadowed by economic weakness and a deep-seated fear for the future. Both paths are real. Both stories are happening at the same time. What's most important for everyone, whether you're an investor, a worker, a business owner, or a retiree, is to understand this divergence. Markets and Main Street do not always move in lockstep. Stocks can rise even when the average person is struggling, and safe haven assets like gold often shine brightest right before a downturn becomes obvious to everyone else. This moment is more than just a minor fluctuation. It's a complex, multifaceted economic shift that will shape the financial narrative for the rest of 2026 and beyond. It's not just about numbers on a screen. It's about the real forces that impact our jobs, our savings, and our daily lives. The headlines are screaming optimism. Stocks are up, the market looks strong, and everyone on social media seems to be getting rich. But what if I told you that behind this curtain of good news, an economic storm is gathering force? The kind of storm the media won't show you, because the real story isn't in the headlines. It's buried in the numbers nobody talks about. Back in early 2026, after that initial market bounce, everything seemed fine. But smart investors, the ones who manage billions, noticed something alarming. Quietly, without any public announcements, liquidity, the lifeblood of our financial system, began to tighten in major banks and funds. Most people don't see the invisible threads connecting Wall Street to your local economy, but I'm here to tell you, those threads are starting to fray, and the first cracks are already showing. It all began with quiet alerts inside mid-sized American banks. Now, officially, everything was perfect. Public statements assured everyone that all systems were normal, but behind closed doors, insiders saw a very different picture. Short-term funding lines, the money banks use for daily operations, were being subtly reduced. The rates banks charge each other for overnight loans ticked just slightly higher than normal. It's a tiny change, but in the world of high finance, it's a tremor before an earthquake. Certain risky investments were quietly being hedged, a move to reduce market exposure. This kind of activity rarely makes the news, but for those paying attention, it was a clear warning sign. The big institutions were battening down the hatches, preparing for turbulence. While the stock market was celebrating, another asset class was telling a completely different story: precious metals. Silver futures jumped after small liquidity shocks rippled through the system. Gold not only held its gains, but saw a significant increase in buying from large institutions. So why does this matter? Because metals don't lie. They don't run on hype or social media trends. They reflect a deep, underlying fear of instability in the financial system, even when stock indexes are hitting new highs. Investors who follow these trends know that when gold and silver rise while stock market optimism is surging, a dangerous divergence is forming. And historically, this divergence almost always precedes a major market correction. It's the classic canary in the coal mine, and right now, it's singing a worried tune. Adding another layer of danger to this mix is the retail rush. Fueled by social media hype, a flood of everyday investors poured into tech and AI stocks chasing quick profits. The fear of missing out, or FOMO, was at an all-time high. Options trading, a way to make leveraged bets on the market, spiked to record levels. This is precisely when markets are at their most vulnerable. You have huge crowds of people chasing the upside, convinced the party will never end, while the insiders are quietly building their lifeboats and preparing for the downside. This retail frenzy creates incredible volatility. When the first real shock hits, that excitement turns to panic in an instant, and the exits, the ability to sell, can vanish almost overnight. As if our domestic situation wasn't fragile enough, global pressures are making things even worse. China has started restricting exports of certain critical industrial materials. Energy prices in Europe remain volatile, creating uncertainty for global manufacturing. And major emerging markets are showing clear signs of slowing down, threatening the supply chains that American companies rely on. Now, you won't see these issues in the daily stock market report, but they hit U.S. corporations where it hurts, their bottom line. If a company can't get the materials it needs to build its products, production slows, earnings fall, and eventually its stock price follows. This global tension is like a slow-burning fuse, invisible in the daily headlines, but felt deeply in the risk models of every major financial institution. But markets aren't just about numbers. They're about human psychology. And right now, investor psychology is at a critical tipping point. After some earlier volatility, fear has temporarily vanished. Confidence is incredibly high, thanks to rising stock prices. And leverage, or borrowed money, is increasing across the board. This is the exact environment where a small, unexpected shock can trigger an outsized, catastrophic reaction. If you look at history, major market collapses rarely happen when everyone is scared. They happen when everyone is overconfident, just like now. The psychological setup for a crisis is firmly in place. Beneath the surface, financial analysts are spotting more unusual patterns. The spread, or difference in interest rates between super-safe government bonds and riskier corporate bonds, is widening, a sign that investors are demanding more compensation for taking risks. The short-term borrowing costs for mid-sized companies are rising, making it harder for them to operate. And deep within the complex world of derivatives, there are growing liquidity mismatches. These are the quiet indicators that seasoned investors watch like a hawk. And right now, every single one of them is pointing toward increased fragility in the system. Even a minor disruption, like a delayed jobs report or an unexpected jump in commodity prices, could trigger a cascade of failures. The recent market rally has been driven almost entirely by technology stocks, especially those related to AI. But a huge portion of these gains are built on hype and future promises, not on current real-world profits. We're seeing some companies report wildly overestimated growth targets that they're unlikely to meet. Venture capital money is hyper-concentrated in just a few winner-takes-all firms, creating a single point of failure. And both retail and institutional investors are dangerously overexposed to tech indexes. This combination is a powder keg. If confidence in the tech story falters, even for a moment, this bubble could deflate with shocking speed, dragging the entire market down with it. So, what are the big players doing? The institutional money, the smart money, is making moves. Quietly, of course. They are rebalancing their portfolios, shifting money out of risky stocks and into safer assets like precious metals and inflation-protected bonds. They're increasing their cash reserves, making sure they have liquidity to weather a storm or snap up bargains after a crash. And they're using complex derivatives to hedge against a correction in the tech sector. For the average person, these moves are completely invisible. But when the biggest players in the game start taking defensive actions on this scale, it's a massive signal that they're preparing for a major market event. This creates a massive disconnect between what the public sees and what's really happening. You see headlines like "stock surge" or "tech optimism returns." But behind the scenes, the reality is that employment data shows persistent weakness, industrial activity is slowing down, and investor sentiment is deeply divided between the euphoric retail crowd and the cautious institutions. This disconnect between the narrative and reality is what sets the stage for a sudden, violent shock that most people will never see coming. No one can predict the exact trigger that will set everything off. But based on the trends we're seeing, it could be anything. A round of unexpected job cuts at a major corporation, a sudden surprising interest rate adjustment by the Federal Reserve, a new international supply chain disruption that halts production, or a sharp, unexpected move in commodity prices. All it takes is one significant event to cascade through our fragile financial system, unleashing volatility that we haven't seen in years. So, for anyone trying to navigate this economy, here's what to watch over the next few weeks. Keep a close eye on precious metals prices. If they continue to surge, it means the big institutions are still getting more cautious. Watch credit spreads. If they keep widening, it's a clear signal of growing risk aversion. Pay attention to consumer confidence surveys. A decline predicts slower spending, which is bad for the economy. Look at tech stock valuations. Extreme overvaluation is a classic sign of a bubble about to pop. And finally, follow global trade headlines. Any sudden disruptions could be the domino that starts the chain reaction. We are in a moment of quiet, unnerving tension. On the surface, markets appear stable. Social media is a party. The headlines are shouting optimism. But just beneath that surface, liquidity is tightening, the job market is under pressure, safe haven assets are rising, and retail investors are dangerously overconfident. The stage is set for a major financial shift, and it could happen within weeks. History teaches us one very important lesson. The loudest markets are rarely the safest. And right now, the quiet signals are screaming if you just know where to look. Before we finish, please remember this content is for educational and informational purposes only and is not financial advice. Markets are unpredictable. Always do your own research and consult a qualified professional before making any investment decisions. By now, the signs are everywhere. If you know where to look, stocks are rallying on what feels like pure optimism. Retail investors are cheering every green day. And the headlines? They're painting a picture of a booming, recovering economy. But behind the scenes, Wall Street insiders are quietly preparing for impact. And two assets, silver and gold, are screaming the truth. The real storm hasn't even begun. Today, we're diving into the hidden collapse. The story nobody is telling you about America's financial future. Let's rewind to February 2026. This period has lulled most Americans into a false sense of security. The major indexes are up, big tech earnings look solid, and the hype around AI and crypto is fueling incredible optimism. It feels like the good times are here to stay. But if you look beneath the surface, the story changes. Credit spreads are widening, liquidity in the financial system is getting tight, and corporate debt levels are absolutely staggering. Think of the economy like a massive bridge. From a distance, driving over it, it looks perfectly stable. The traffic is flowing, the sun is shining. But underneath, the support beams are cracking. Tiny fissures are forming under the immense pressure. In financial markets, those cracks don't stay hidden forever. Eventually, the strain becomes too much, and the entire structure is at risk. While mainstream media has its eyes glued to the stock market, silver has been telling a completely different and frankly more honest story. We're seeing sudden violent spikes in futures volatility. We're witnessing massive short covering, where traders who bet against silver are forced to buy back in, driving the price up. And most importantly, hedge funds are quietly increasing their positions in physical silver. There's a reason for this. Silver has always been a barometer for financial stress. It's the canary in the coal mine. When the paper markets, stocks, bonds, derivatives are overleveraged and the global supply of physical metal tightens, silver is one of the first things to react. The lesson here is simple, and it's one that has been proven time and time again. If silver starts to tremble, the broader markets are usually next to follow. So where does this leave the average person? By mid-February, retail investors are doubling down. FOMO, the fear of missing out, is pushing many to pour their savings into high-flying tech and AI stocks. Leveraged options trades have soared as people make bigger and bigger bets for quick profits. Social media has become a giant echo chamber filled with endless posts of buy the dip and to the moon. This behavior, while completely understandable, dramatically magnifies the risk. When the first real shock hits the system, that optimism will flip to panic in an instant. And that panic selling will accelerate the crash exponentially. It is a tragic pattern we see over and over. Retail investors are often the last to join the party and the first to get wiped out when the music stops. They rarely see the first wave of a crisis coming. Meanwhile, a storm is brewing on the global stage, adding even more fuel to the fire. China, a huge player in the industrial metals market, has been tightening its restrictions on silver exports. Energy markets over in Europe remain volatile and unpredictable. And we're seeing clear signs that emerging economies around the world are slowing down, which has ripple effects for everyone. These external shocks are like hidden dominoes. They might seem distant and irrelevant to most Americans, but they have a direct impact on global supply chains, corporate earnings, and ultimately the stability of the U.S. market. A slowdown in Asia or a crisis in Europe won't stay there for long. All of this puts the Federal Reserve in an impossible position. Policymakers are trapped. If they cut interest rates too quickly to try and stimulate the economy, they risk sending inflation soaring again. But if they hold rates high or raise them further, they risk stalling growth completely and tipping the economy into a deep recession. Their public statements have become carefully vague, almost intentionally confusing. But internally, you can be sure the balancing act is incredibly tense, and markets absolutely hate uncertainty. Right now, every word from the Fed, every subtle signal, carries the weight of a potential market shock. One of the most dangerous patterns we've seen in decades is playing out right now, this massive divergence between the stock market and the real economy. On one hand, you have the stock market, which is incredibly optimistic, rallying higher and fueled by hype. On the other hand, you have the real economy, which is showing serious signs of weakness. Job losses are starting to mount, hiring is slowing down, and consumer confidence is declining. And then there's the third piece of the puzzle, safe haven assets like gold and silver, which are rising steadily. This tells you that the smart money is getting nervous. When these three forces, a euphoric market, a weakening economy, and rising safe havens, diverge for too long, a correction isn't just possible, it's inevitable. And historically, these corrections happen suddenly and violently. So, what could be the spark that lights the fuse? It could be any number of things. A wave of major layoffs in the tech or logistics sectors, a sudden, unexpected rate adjustment from the Fed, a sharp shock in commodity prices like oil or natural gas, or an unforeseen geopolitical event that shakes global confidence. It doesn't take much. In a system this fragile, one single trigger can set off a chain reaction that cascades across the entire market. And this brings us to the most important question. What are the insiders doing right now? While retail investors are cheering the rally, Wall Street is quietly preparing for a storm. They are increasing their cash reserves, getting ready to buy assets on the cheap. They are hedging their exposure to overvalued tech stocks. They are allocating more of their portfolios to precious metals like gold and silver. And they are quietly reducing their exposure to the most vulnerable assets. The thing is, by the time these moves become obvious to everyone, it's often too late for the average investor to react. We also have to remember the psychological factor. Markets aren't just numbers on a screen, they're a reflection of human behavior. And right now, the psychology is classic pre-collapse. Overconfidence is at an all-time high. Fear is incredibly low, and leverage, borrowed money, is creeping back into the system. This is the perfect setup for a sudden and dramatic fall. The louder the crowd celebrates, the closer the system is to snapping. So why am I telling you all this? Understanding these patterns isn't about spreading fear or panic. It's about building awareness. It's about learning to look beyond the headlines. Start observing the price of precious metals. Watch the real economic data, like employment numbers and consumer confidence. Notice what's happening with global supply chains and international trade. Track financial indicators like credit spreads and liquidity. These are the indicators that reveal the hidden shifts in the economy long before the mainstream news catches on. In early 2026, the U.S. economy stands at a critical crossroads. The markets might continue to rally in the short term, fueled by hope and hype. But the real economy may continue to weaken beneath the surface. The steady demand for safe havens suggests that smart money sees significant risk on the horizon. History teaches us a valuable lesson. The loudest, most celebrated markets are rarely the safest. It's the silent warnings, the subtle movements in silver, gold, and credit markets, that often signal the first tremors of an earthquake. Those who watch carefully and act strategically will be the ones who can navigate the coming storm successfully. But those who only follow the headlines may be in for the harshest surprises. This is the hidden story of America's financial crossroads, the deceptive calm, the false confidence, and the silent storm building just beneath the surface. Please remember, this content is for educational and informational purposes only. It does not constitute financial advice. Financial markets are volatile and unpredictable. Always do your own research and consult with a qualified professional before making any financial decisions. Thanks for watching, and if you found this valuable, please consider subscribing for more insights. Stay safe and stay informed.